Well, the tough times for technology continue. Take a look at Snap. Stock fell below the IPO price of 17 yesterday. First time it cracked the IPO price since going public, obviously. The problems could continue for Snapchat's parent company, with the decline coming just a few weeks before the lockup period ends. Joining us right now, Federated Investors Chief Equity Strategist Phil Orlando. And Phil, lots to talk to you about today with the FOMC two-day meeting, with the ECB, with earnings season upon us. But first, when you look at what's going on with technology, Snap is one example, but you could look at Facebook, you could look at Amazon, Netflix. They've sort of rolled over last month. What's going on?
So tech's had a phenomenal run coming out of the election. I think they were poised for a breather, and that's exactly what we're seeing. Seasonally speaking, technology tends to underperform in the summer anyway. Healthcare tends to do better, and that's exactly what the trend is here. But you had such a strong move with technology. You were due for a correction, and I think that's exactly what you're getting.
So you also have a tough story on Blue Apron, having trouble in the first 2 weeks of its trading. The stock also broke the IPO price. That was $10 a share.
Well, two IPO companies. We're not talking about seasoned companies with great capitalization and management and a track record. So, again, that's one of the risks of investing in the IPO market. You don't know exactly what you're getting. Sometimes it works, sometimes it doesn't.
This is such a shift from the late 1990s, when it was the IPOs that were going through the roof and there was so much froth in the markets around new companies coming to market. Now we have a tech sector booming, but it's the incumbents. It's Amazon, it's Facebook. How do you explain that? Why is the market more focused on incumbents today than it is on startups?
Sure. I think that's simple. The companies that are doing great right now, the FANG companies per se, those companies are generating much stronger growth than sort of the older legacy companies. The situation in the 90s was very different because we had a macro backdrop of the Y2K phenomenon. Literally every company, every person in the world was buying new boxes, new chips, new software, new everything in order to be compliant with the calendar changeover. So there was forced global demand that we're not seeing right now. The demand right now is coming in those FANG companies that are producing well above average growth rates.
So does that mean stay away from IPOs? Just stick with the blue chips?
Well, do your homework. There are some firms, and our Kaufman division is one that's very good in terms of identifying IPOs. They do a lot of due diligence. They visit with these companies as they're private and get used to them as they're about to go public. Investors attend the meetings, dig through the numbers, get comfortable with what's going on, and make a calculated bet.
So dig through the numbers in terms of the broad economy right now and the profit story, because we've got second quarter earnings coming out beginning this Friday with the major banks. That's going to be one to watch. JP Morgan, Bank of America, PNC, all reporting this week. What's your expectation, and how do you see the profit story playing out in the second quarter?
So FactSet is looking for sort of a 6 to 7% year-over-year increase in the second quarter.
In profits.
In profits.
Profits were up 15% in the first quarter.
Correct.
So we're talking about 6% now in the second quarter.
We think that FactSet's too low. We think that number is going to be low double digits, something in the 10 to 13% neighborhood. We think that the banks on Friday are going to give us some pretty good numbers. So on balance, we think it's going to be a pretty solid quarter, leading to overall for the full year sort of a low double-digit earnings. We're looking for 130 for the full year off of 118 for last year. So we think it's going to be a solid corporate earnings year.
The market and the economy doesn't seem to be affected by the lack of progress on healthcare reform as well as tax reform. How do you see the markets reacting over the course of July?
I think you're exactly right.
Big question, actually.
What's driving stocks right now are corporate earnings. First quarter earnings, as Maria pointed out, up 15% year over year. We think second quarter is going to be decent as well, sort of a low double-digit kind of number. There's no Trump, if you will, in that $130 number. The work that Thomson Reuters has done suggests that if we can get corporate tax reform, the leverage associated with every 1 percentage point reduction in the federal tax rate from 35% to something is $1.30 for every 1 percentage point decline. So if we can go from 35% down to, say, 20%, that could add $20 in corporate earnings to the S&P. That's not in this $130 number right now, but it could be in a $150 number looking out, let's say, to 2019 or so, if Congress and the administration get something done in the next year or so.
I totally get that this market is trading on fundamentals and on earnings, but there's a real expectation that we're going to see something get done. So, yes, maybe the numbers are just trading on, a good profit story, but at the end of the day, if we don't get tax reform, as Jason's talking about, Wouldn't that be a big blow to this market?
We've got a slide in our presentation deck that after Trump had done the successful State of the Union address in late February, about 70% of market participants thought we would get something done this year. That 70% is down around 30% right now. So there's been a lot of
expectations have
a lot
gone
of
down.
Optimism out of the Trump trade, if you will.
If they can't get the 15% that Trump wants, but they get 25%
Right.
on the corporate tax rate, you said every notch matters. Is that good enough?
Well,
I don't think it's good enough.
Well, no, I disagree, Maria. I think that's exactly the point. Trump is a deal guy. I think he threw 15% out as a bargaining chip. We'd be very happy with something in the 20 to 25% neighborhood, knowing that the global corporate average is 22%. The idea is you've got to close that gap, because we've created a disadvantage for ourselves on the corporate tax side. We've got to fix that. We don't need to get to 15 to fix it, but something in the neighborhood of 22%, one side or the other, I think could get the job done.
You know, I spend a lot of time talking to average Americans who are hardworking, trying to figure out what to do right now, and they're getting nervous because they're not seeing this stuff get done. They're not seeing health care. They're not seeing tax reform get done, and they're seeing the market go up, and they're wondering, is this a bubble? Should we not be investing?
Well, it's not a bubble because the valuation is still very moderate. You're trading at about 18 times forward earnings. We think multiples ought to be closer to 20. So this is not where we were in the 1990s with the Y2K bubble, where stocks were up around 25 or 30 times earnings. So that's not the situation. And I think, frankly, the Republicans made a mistake in starting with health care. They should have started with tax reform or infrastructure. Were some areas that we had some bipartisan support.
Real quick before you go, because there's a worry that as this economy is gaining traction, the Federal Reserve is going to smash it down with raising interest rates. We got Janet Yellen on the Hill this week. What are you expecting from her?
So I'd like her to talk about the decline in inflation. Core PCE has gone from 1.8 to 1.4 in the last 6 months. I'd like to see the justification of what the Fed's done, what they're planning to do in light of the backdrop of decelerating inflation.
So you are then agreeing then that there's a chance they could sort of smash an economic recovery just as it's gaining traction?
I think that what the Fed is going to give us in the second half of the year is one more quarter-point rate hike, and they'll start to develop a plan to start to unwind the balance sheet. But it is a concern that in the face of decelerating inflation, will they do too much that theoretically could hurt economic growth?
Yellen does not want to smash this for recovery.
I wouldn't think she would.
She is a dove. She is not out there.
And from a legacy standpoint, the last thing she wants, if she does leave office next February, is to be the Federal Reserve chair that created the double dip.
Yeah,
that is not what she wants on her resume.
Phil Orlando, always great insights from you. Thanks so much, sir. Phil Orlando will be